attendees are in listen-only mode.
Good afternoon, everybody. This is Stan and Jack, and we're doing a webinar today called Risk Management in Trading, and this is part one of that series. And we'll get into the series and talking about what we're going to talk about today in detail in just a few moments. Our disclaimer, of course, we provide technical analysis, and none of the materials that we share here are intended to be a trading signal per se. We're here to show you the way we do our technical analysis, what we see in terms of the markets and trends and resistance and support and so on and so forth. And of course, we hope that you benefit from that work and that you can transfer that to your own charts. Anyway, that's our disclaimer. Let's take a look at our outline for today. This is what we're looking to cover, and we're going to cover this in a multi-part series over the coming months. And risk management is probably, in my opinion, the thing that separates really great traders from average traders, okay? Great traders are very good at risk management. And so risk management for me is really three things. It's there's the money management side, which we're going to talk a little bit about that today. There's the psychology side of trading, and there's also the trading system side, okay, which we'll talk a little bit about that today as well. So these three themes will be sprinkled throughout this multi-part series. I think we're planning on 4 parts at this point. And for today, what we want to talk about is we want to talk about the different types of entry strategies and the different types of money management tools depending upon the type of market structure that you're in. So, for example, do you trade a trending market the same way you trade a consolidating market? Do you think about your stops the same way? Well, I wouldn't recommend that. I would recommend that you look at all 4 of these different types of markets differently, and you have to look at your stop systems differently and how you manage risk. And we will walk through some examples. So your 4 different types of markets, if you will, or price action: trending, consolidating, breakout, or corrective, okay? And they all require a different mindset, if you will. We'll talk a little bit as we talk about all 4 of those. We'll talk about position sizing, volatility, and managing risk, okay? So, you know, if you're an ES trader and you have a standard where you use a 2-handle stop, let's say. Well, in a typical, you know, VIX of 10 or 12, that makes a lot of sense. But guess what? If you all of a sudden have a VIX of 30 and you use a 2-handle stop, I think you're going to have a problem. So stops should be based on volatility. I'll show you a few different ways of doing that. Position size, no one can determine this for you because depending upon the kind of trader you are, what your hit rate is, what your hit rate is, what your max drawdown is, position size has to be determined by your win ratio. How many consecutive losses do you have, et cetera, et cetera. We'll talk about position size a little bit later. We'll talk about some standard rules that are rules of thumb that work. We'll also talk about max drawdown, which is a very important statistic that you should have for your own trading. We'll talk about stop systems and which do you use when. And there are a whole bunch of different stop systems. We'll walk through them and just talk through some basic examples. And we'll talk about exits. And, you know, exits, how can I say this about exits? Exits and greed tend to go hand in hand, okay? People like to sometimes, well, fear and greed both, okay? Sometimes people exit too soon, sometimes they hang on to their trades too long, and so the question is, are you happy with 60%? And that's sort of my standard. It's like 60% of a swing is good enough for me. I don't need to capture it all. If I'm on the winning side and I capture 50 to 60%, I consider that a big winner. It takes the pressure off. I'm not greedy. I'm not, you know, fearful. I think your expectations are very important in terms of how you set them. So we'll talk about exits, and we'll talk about capturing your vital statistics, because if you don't know your stats, if you don't know your max drawdown, if you don't know what your win ratio is, if you don't know how many consecutive losses you average, it's going to be real hard for you to pick out the appropriate position size for a trade. And so we'll talk about statistics at the end and the kind of things that you need to capture. and we'll be picking that up at the next webinar. So I think that's what we're looking to do today. And I would just encourage everybody, questions in the GoToWebinar tab as we go through this, and we're going to try to make this valuable for all of our subscribers and anybody else who happens to be listening as well. So Jack, with that said, are we ready to begin?
I think we are.
Okay. Let's start with these 4 different types of systems. I'm sorry, different types of pricing structure in the market. Okay, I'm going to show an example of a trending instrument right here. Okay, this is live cattle. Okay, live cattle went limit up yesterday. It gapped up, I think, $4.50 today, and then of course retraced all of it. And so this market, you know, think about this market in terms of how volatile it is, okay? You know, we have a window here, 518. We also have a longer-term trend line. Let me just show you the daily chart here quickly. So we have this longer-term trend line coming in up here. And so, you know, how would you trade this? You know, where would your entry be? Well, first of all, this is not a reversal pattern and it's not an entry, and we're not even mature yet in terms of the structure and the pattern. The pattern here, I would say, is a WX, YX, and then we have a 5-wave extension here, a 1, 2. In traditional Elliott terms, this is a 1, 2, this is a 3, looking at a 4, probably a 5th wave with some sort of divergence, so we're waiting on the setup, but this is setting up to have a very nice corrective move. Now, we talk about here in the 4 different types of markets, there's trending, consolidating, breakout, and corrective, so we're getting ready for a corrective trade, okay? But take a good look at this market. I mean, this is not a trade without risk, okay? Trading this versus trading natural gas, which is consolidating, or the E-mini. Let's just go to the E-mini quickly, okay? So here's the mini, and what are we in? We're in a consolidation pattern. Okay, and I'm looking at the mini on a very short-term basis. So let's just give me a second to pull up the chart here. And so, you know, your mindset in a market like this, looking at that corrective pattern versus a market like this, which is consolidating, okay? So in a market like this that's consolidating, what are you doing? You're trying to capture basically the range. That's all you're trying to do. So the range today was roughly 10 or 11 handles. You're trying to capture 6. That's really it. 60% of a swing. That's all you're trying to do. So I think the mindset has to do, the way you trade it and the way you manage risk has to do with the type of structure you're in and the type of price action you're in. So let me go to live cattle, and I'm going to show you exactly how I would manage risk in this trade, okay? This is very similar to the coffee trade we did last year. So, you know, I'm going to wait for the structure to mature, and I'm going to wait for a reversal pattern. But the thing I'm going to do is, first of all, I'm going to understand my risk. Okay, now a tool that I use is average true range. I use average true range, 5-day average. Right now, the average true range on a per day basis in cattle is $3.18. Okay, that's a pretty wild range, okay? I would take a third of that, which is roughly speaking $1.06, and that would be my stop, okay? I would then look at $1.06 and I would say, okay, how much is $1.06 in per contract, okay? How much am I willing to lose, okay? 2% of my account, 3% of my account, whatever I'm willing to lose, that's the number of contracts I'm trading, okay? And I never allow that value to exceed 20%. That's basically how I set up a trade, okay? So I'm going to look at this when the structure matures, and I'm going to look at, you know, if the average true range is at this number, which it will probably be a bit lower, I'm looking at a stop of $1.06, okay, at this point in time. And I would hope when we get the setup, which we don't have yet, but when we get the setup, and I have a number here also, a key Fibonacci level. I use Fibonacci's and trend lines both for resistance, and so you can see right here I have 130, let me give you the right number, 136,825. Okay, so that's a number, and there's the trend line right above it. So, you know, if we get this fifth wave that I'm talking about, like this, okay, and I go $1.06 above it, okay, as my stop, chances are the trade is going to work, okay, but I have to be willing to risk that much. Now, do I only put on 2 contracts or do I put on 20 contracts? Well, that depends upon your account size and, again, what you're willing to risk on a trade. And so this is a riskier trade, and of course there's a larger reward because this should break. This is a megaphone. We should break this lower trend line. Okay, and I'm looking at a low window of 715. So and again, the windows may be off. They can be early, they can be late, et cetera, et cetera. So this is a game of risk, and we have to look for the right setup, wait for the reversal pattern, manage our risk, know what we're going to lose ahead of time before we enter the trade. Okay, and then execute the trade and then manage it. So that's live cattle. That's just an example of what I'm talking about when I talk about managing stops based on volatility, and I'm giving you an example of a corrective trade. And the last thing I want to say, Jack, before I throw it over to you is, and I want to just differentiate a counter trend trade from a corrective trade, okay? If we're trending down, for example, in oil, okay, I think everybody here who is a subscriber knows that we're looking at like $43 and getting to a low sometime in July, and we may even go lower than that, okay? Anytime you have a counter trend trade, there is increased risk, okay? When I look at a corrective trade, that's not necessarily a counter trend trade. A corrective trade for me is something that's going to last at least a month. It is something I can swing trade. Most counter trend trades carry a lot more risk, and they should be day traded only, in my opinion. So I don't know what you think about that, Jack, but you may want to add some comments. So I just gave an example of a trending market and how trending markets can sometimes be volatile at reversals. Okay, so that's just the example of live cattle, and this is going to be a very, very nice setup and a very, very good trade. I'm looking forward to it, and we'll see how it plays out. So, Jack, throwing it over to you for another example.
Okay. All right, hang on. All right, tell me when you can see my screen.
Yeah, it's there.
Okay, great. I'm going to look at the CL trade because obviously Stan's just been talking about it, and there's a pretty good example for a couple of reasons. Now, this is obviously in a downtrend, and we've been in a consolidation phase within that downtrend. And we've had a couple of possible reversal patterns form for a decent retracement, which haven't worked out. So here's one from last night. Nice looking double bottom here. We had decent positive divergence. We had a potential buy signal forming here, but it never actually made it back to double bottom resistance. And it breaks down. Now, often, as you get and see here, we had a similar consolidation here, and it broke down. And you will often get a retrace. You didn't get one here, but the thing is, as soon as when I was doing the chart this morning, I was talking about this possible trend line here had broken, and that reverted us back to the channel which I already had here. And I was saying channel resistance was channel support was in the 45.20 area, and actually this was off the chart. It turned out to be in the 45.30 area, but that was the obvious target. It went and made that obvious target. There's a couple of things to say in terms of trading there. One, if you're short oil, then that's a very good place to be taking a lot of profits. Because at that stage, the chances of getting lower soon are much reduced. The other thing is, once you've got this break, we didn't actually see any backtests really worth the mention on oil today, but it would quite often come back and backtest the broken support level. And if it does, you've got an entry right there, and you've got an obvious target. So this is very much, you're always going to have the higher probability trade. The trend is, when the trend is on your side, then you've got the higher probability trade. You always have to be more careful with corrective trades. I'm just going to move on to the LE chart and make an observation there. One, these are short-term patterns. The chart that Stan was showing you, when I say short-term, obviously this one's lasted a couple of months, but the one that Stan was looking at was, the patterns taking, thick end of a year to form. So this is shorter term, and we're in a very clear rising megaphone. We've broken out here, beautiful back test. You will so often see that. Very nice entry there. Here, you've got a beautiful support trend line, 1, 2, 3 touches. if you are taking longs, then you've got a very clear level that you're taking longs against. And obviously the odds of you'll quite often in a strong uptrend, you'll quite often see the support trend line break a couple of times and continue upward, in which case you have a new support trend line to consider as your support level. But in terms of if you've got a nice three-touch support trend line, then really your odds of getting a successful trade on the long side drop considerably after this level breaks. But the thing is, as long as it's staying above that level, you can trade against it into higher targets. It has not broken down yet. It could easily go higher. And I would just note on cattle here, and again, this is something you bear in mind. I mean, these things aren't hard and fast, and they don't always make target by any means. But here, you've got a particular pattern set up. And here you've got a rising megaphone, which normally break down, but in this instance is broken up. And here you would calculate it as basically you'd expect to make 19 from the break. That is a target of 142.5. And it's not broken that trend. It may well make that target. So again, you're bearing in mind you're in a trend. It's a strong trend. You've not broken the trend support. You can basically buy the dips against the main trend support breaking. And if you've got a target above that you are aiming towards or below on the oil chart, then it improves the odds in your favor, and also gives you a very good indication where you need to lighten up.
Yep, that's right. Yeah, I like the idea in a trending market, especially one like this, in terms of entries, and this webinar is about entries and exits. It's like your entry should be as close to that lower trend line as possible, okay? As you can see, it's been hit once, twice, 3 times, 4 times, 5 times, 6 times. I mean, it's been hit multiple times. The chances of it actually holding, we will vary between, of course, the upper and the lower trend line, but, trying to get into a structure in the middle of the structure, it doesn't make any sense. You got to give yourself the best odds possible for a turn, and those odds typically happen at extremes. And so as traders, we have to get used to trading at extremes and managing risk at extremes. I think that's the idea.
Yep.
Okay. Do you have another example, Jack, or shall I show another one?
Hang on. Are we just looking at strong trending examples at the moment? Well,
trending, consolidating, breakout, and corrective, and how to trade them.
This is an example of timescales. This is a trend. Of course, on the bigger picture, this is a retracement trend. But nonetheless, it is trending down, and it has been trending down for 4 months now. It's now here you've got. This wasn't an easy one to work out. This one, by the time I drew this trend line, I was just saying, last chance if we break below this, then I don't know what I don't have a pattern here. But again, you've got clear resistance here. You've got clear support here. You've got levels. The weekly pivot, monthly pivot, always worth keeping an eye on the weekly pivot particularly. But here you've got previous high. You come back up. You do a marginal new high. You're failing. You've got negative divergence on RSI. And I drew this in because this has actually got pretty good odds of coming back to retest this low. When it retests that low, you haven't reached that trend line. The lower trend line is not necessarily a target at all. You wouldn't really expect it to be hit. You've got an interesting looking counter trend short back down into here, and here you've got an area where you start looking around for a long against this trend line here. It's potentially a very nice setup. There's a lot of these. You get an awful lot of retests on trends. You get retests of broken levels, you get retests of trend lines, and all of these are good entry opportunities, which improve your odds.
Yep, absolutely. Okay, I have an example, Jack, that shows legging in and legging out of a trade.
All right, I'll throw it back to you.
All right, great, thanks. Okay, from a risk management perspective, the question is, how do you actually, first of all, there's legging into a trade, which I'll talk about later. I'm going to talk about legging out of a trade. And we have a system that we use. It's fairly reliable. It's not 100% reliable. It doesn't work all the time like anything else in trading, but it's something that I like to use. I'm using coffee as an example. This is a trade we did on the weekly call. And this is a corrective trade. Okay, this is a corrective market, and if you look at coffee, we were trading this long because we thought there was a low that was put in here back in January, and we followed this up and we said, here's the trend line. we're looking for a reversal, and so we had good reason to look for a reversal first of all, and we waited for the setup here, and we entered here on this lower high. And so bottom line is I'm showing you how we legged out of this trade. Okay, so this last swing up, all I'm going to do very, very simply is this, and this is just a standard I use whether I'm doing a longer term swing trade or whether it's even a shorter term, just a couple of day trade. Right here, I'm just going to draw a Fibonacci. So the 50 back area is right here, and what I really try to do as much as possible is just encourage people, when you're in the golden ratio zone, take off a third. Okay, take off a third of your trade. So here we put the trade on, we took off a third here at the 50 back. You could choose to do it earlier or later, but in the golden ratio zone, typically a decision gets made. If this market was going to go higher, it would have done it from the golden ratio zone somewhere, from inside of this, from inside of that swing. So, if you do a trend line, for example, you can see why that makes a lot of sense. So right here, we did get a reversal. It did go higher, but it went maybe not quite 50 back to the previous swing, maybe a little bit more. But bottom line is we got out of a third of our trade here. We put our stop to even, okay? If the trade reverses on you, guess what? You're stopped out, but you have no loss, and you're walking away with 1/3 on the trade, which is, by the way, just fine. It's called a single, okay? Nothing wrong with hitting singles in this game. So what do you do then is you wait until the trade develops and you wait for a 3 down. This is the second exit, okay? So 3 down, second exit. There was also a trend line, by the way, that came, if I remember correctly, the trend line, it's not on this chart, this is a 4-hour chart, but the trend line came in right through here. So we had good reason to exit on the second third. We were 3 down, okay? And in the system that I use, I look at the market typically in 3 waves. So 3 down, and typically if you're going to reverse previous degree wave X, the market could have very easily have done this, okay? And you don't know what the market's going to do. No one does, okay? So the idea of legging out of a trade is you capture profit along the way. Now, frankly, we were looking for a turn here. We were off 2/3. We were looking for a bounce. And if you guys remember, we broke the trend line and we just held on to the trade, okay? We waited for the next 3 down. You can see it right here, the A, B, C, and we took off our third, and we were out of the trade here at the Y wave. Okay, and what did it do? It back tested, and we were thinking it was going to go higher. We were waiting on the next setup, and it went lower. Okay, so here we had nothing on. We missed this last little leg down, and do I care about that? I don't. Why? My standard is 60% of a swing. If you capture it, that's a great standard. If you can do better, wonderful. Okay, I think the appropriate expectations are very important for you as a trader. If you have, like, for example, if you're a day trader capturing 4 handles a day, it's a great goal, okay? A lot of people want to do more than that. Great, wonderful. But you know what? 4 handles a day, if you can do that consistently, that's good money, okay? If you can capture 60% of a swing consistently, that's good money. So I think that sometimes we set unrealistic expectations around performance, okay? And I think sometimes that gets in the way, and that gets that's part of the psychology of trading, which we'll talk about. So I wanted to share with you guys.
And also, just to mention, by doing that, you can actually get a result which is actually very good, and you can make it look like a failure by setting an unrealistic target.
Exactly. I think that's right on. So, taking off a third and putting your stop to even and getting stopped out, you might say, hey, I just made a bad trade. And in my book, you hit a single. Okay, so you move on, you make the next trade, and so on and so forth. So I wanted to show you this very simple system of legging out. So 50 back, you take off a third, 3 down, and some sort of support. It could be a fib, it could be a trend line. You take off a second third, that's near target. Okay, this was near target for us, and then you get we got a downside surprise here. So we were on the right side of the trade in this particular case, and we took off our last third here. So that's a very simple system. It works, and I would encourage everybody, again, manage your risk. Get out of a third, stop even wherever it makes sense for you, and I think that's something to pay attention to. So Jack, I'm going back to our outline. So I think we've covered like corrective, we've covered trending. We really haven't done breakout or consolidating yet. Do you have an example?
I talked about a couple of examples with CL and LE already, actually.
Okay.
Because that LE, depending on your time frame, that LE is definitely a breakout trade. And CL, actually, when I was talking about back tests, again,
yeah,
I can talk more.
Well, I want to show an example of a breakout trade, and the one that comes to mind is copper. Let's just go to copper for a minute. Because out of a consolidation pattern, you get a breakout, okay? And how do you trade a breakout? And how do you manage risk in a breakout? I think that's the piece that I want to talk through. So let's go to copper. And here's copper, but what I really want to talk about is the copper daily chart, okay? Remember this triangle, okay? Here is the breakout trade, okay? And so, and typically what you see in a breakout trade is, and this chart needs a little bit of love and care here. I have to reposition my trend line. But bottom line is typically what you see here in a breakout trade is you typically break out and you come back and you back test the breakout trend line and then you go, okay? So what you could do in this trade is you could look at this as a triangle, okay? Wait for the X wave. You could put a third on here and start pyramiding your trade, okay? Pyramiding is not something we've talked a lot about, but typically you manage your risk through managing size, okay? Managing the size of your trade. So you put 1/3 on if you have a good sense that this is going to break out to the upside. You put 1/3 of your trade on while you're inside the triangle with a stop below the trend line, okay? You put on a second third after you have a clear signal that you have broken out, okay? And then you find a place later in the trade, like for example, this nice back test here where you might put on a third or your last third, okay? So you can pyramid a trade, and I would pyramid a trade by adding no more than 2 additional legs. And then what you have to do is take off your last leg in first. Okay, you take off your last leg in, then your second leg and your third leg, and you find key Fibonacci's and you find key trend lines where you do that. So basically, that's pyramiding and looking at a breakout trade. Okay, pyramiding is more of an advanced technique. I think, you know, waiting for the breakout, waiting for the back test, getting into the trade, and then managing it the way I just described, taking off a third, putting your stop to even, et cetera, et cetera. If you're new to trading, that is certainly something you can do. There's nothing wrong with that. And there's also in a breakout trade the whole idea of pyramiding, where you have 3 parts to your trade. You manage your risk through size. Okay, so you have a third on. You can put a stop or not put a stop, because if you're managing your risk through size and you have a very small position on, you know, you may want to manually have a stop in terms of using your own judgment, you know, in terms of taking off the trade. If you're a more advanced trader or a more experienced trader, that's certainly fine, trading without a stop. I do that sometimes when I have a very small size on. But I think what you have to do is, if you're new to trading, is always have a stop and always have a stop system of some sort. Okay, so breakouts are wonderful to trade, but I'll tell you what really sucks about a breakout trade is when you're on the wrong side of it. So again, trend lines are important. Anytime you break a trend line, you get out of the trade, and so that's just my basic 2 cents on breakout trades. So Jack, let's see, what else is left? Shall we walk through stop systems?
Yep, good idea.
Okay, and the only other thing I don't think we've talked about is position size, and we should probably just say a few words about position size. Now, I imagine there are people listening to this that have $30,000 accounts versus people who have $300,000 accounts, and I think what you have to look at is you have to look at your max drawdown. Okay, max drawdown, and if you don't know what max drawdown is, it's if you trade an instrument like oil. Okay, what is your maximum account drawdown, peak to trough? Okay, over the history of you trading that instrument. I think on a per instrument basis, I would really encourage everybody listening to this to know on a per instrument basis, what is my max drawdown? Okay, it goes to calculating your position size. Okay, so let's say my max drawdown in oil is $500. Okay, and and I'm in a position where I'm looking at a trade that has risk of more than $500. Well, in that sort of situation, I'm going to be using a smaller position size than in a trade where, let's say, the risk I'm looking at is only $200. If the risk is $200 and my max drawdown is 5, I may want to put on more risk. There are actually formulas for calculating that, calculating position size, which we will do in the next webinar. But what I want to do is just mention the whole concept of maximum drawdown. I think everybody should have it on a per instrument basis. We will be showing some formulas in the next webinar, part 2. Okay, there's a standard rule of thumb that people use a lot, and I don't use this rule, but a lot of people do. You should plan your initial stop loss to be not more than 2% of your account size. Okay, now if you're only trading $30,000, that's kind of difficult. Okay, so sometimes you have to do 6, sometimes you have to do 8% of your account size, and it depends upon your account size and your max drawdown in terms of what you should risk. But if you're a new trader and you're trying to trade futures and you have $30,000 and you're risking 10 to 20% of your account size in a trade and you're new to trading, I think that's a formula for blowing up your account. I really do. And I think if you have a small account size, you might be better off you might be better off trading options. That's my caution. Okay, so an initial stop loss, I think of it as putting up an ante for a card game. Okay, so there's the potential in a card game to put in a lot more money to play the game. So your initial stop loss should be that. It should be the ante, and you should be able to fold after you have that ante marker hit, whatever that marker might be. So 2% is usually pretty good. I typically run around 4 to 5%, and that has to do with my hit rate and my max drawdown. So 20% is also important. I would normally, under most circumstances, not all circumstances, I would never have more than 20% of my account in any one trade. I think that that can create sleepless nights for a lot of people, and it's just a caution, especially if you're new to trading. I wouldn't have any more than 20% of my account in any one trade. So just wanted to cover off those 2 points.
Something we cover in the psychology of trading. There is as humans, we are wired to look for sure things, but actually they don't exist. If you think you found a sure thing, then you're mistaken.
Yep, absolutely right. Okay, stop systems. Let's just walk through them, Jack. How do you think, Jack, about your initial stop in terms of the way that you trade?
A lot of it has to do with levels. Trades tend to be against a level. The level might be a trend line, it might be a pivot, it might be a short-term low or high, but basically it's against that level. And the first thing to think about is if you're trading against a level, which is often a good idea, is to put the stop beyond that level.
Absolutely. I think that's and also the other thing is a current swing high or a current swing low. That's often a place to look for an initial stop as well. Okay.
On the ES, for instance, if you're looking at the weekly pivot all week this week, that has been a level to trade against.
Yep, it sure has been.
So, and when you have a level like that, then you can trade. You can trade around it. And you can use it as a good level, long and short. You can plan your stops around it.
Yep. Okay, ATR stops, average true range, which is a way of adjusting your stop system based on volatility. I encourage that. You can even use the ATR stop as a form of a trailing stop. Okay, and so that is something to consider, or look at adjusting your trailing stop based on volatility. A lot of people use trailing stops. I particularly don't. I like stops based on structure, as Jack mentioned, and I also like the volatility-based stop. Resistance stops, those are ways of exiting. So, like for example, the trend line on coffee that I mentioned, where we took off our second leg, that was a resistance stop. Okay, so any level, it could be a pivot, could be a trend line.
Well, that channel spot on oil. for instance,
Say
today.
again?
That channel sport on oil today.
Yep, absolutely, absolutely. That's a nice area to take off to take profit. 3-bar trailing stops. That's been around for a lot of years. A lot of people use that in a trending market. They leave on their last third until 3 bars back, until that the low of the 3rd bar back is actually broken, and that's not a bad stop system for your last third, by the way. Trend line stop we've talked about. Regression channel stop, which is different than a channel. If you draw a regression channel from a low to a high, it'll put a channel on your chart, and it's not necessarily it'll contain 60 to 80% of the price action, but if you're in doubt about where to get out of a trade, if you're in a trade and it's going higher, and you want to learn to hold on to your trade, using a regression channel stop is actually a very wise move, because it doesn't contain all the price action, but usually when you're below, if you're long and you go below the regression channel, typically that's the sign of a trend change. So that's not always, but that's a 70% odds that you have a potential trend change. That's just something to be aware of. And managing risk using size. So you can have wider stops with smaller size, and so and sometimes you can trade without a stop if you have a position size that's small, 1/3 of your normal size, for example. So those are just a couple of different stop systems and different ways of thinking about stop systems. Jack, let's talk about exits.
Yep.
How do you think about an exit when you have a trade and it's going well and you're looking to exit the trade?
Well, there's 2 ways of thinking about the exit. If you're on a runner and you think the trend might have considerable legs and you're not quite sure where it goes, but you're thinking it might go some considerable distance, then I'll often use just basically a stop which I'm running up against under a support trend line. If you've got a target well, actually throw me the screen and I'll show you a couple of nice examples of those. Okay. But if you've got, all right, okay, here. Right, if you've got a target, like for instance, if we get, and I'm expecting a retest of this level here, I'm going to be looking around for some support, but I'm thinking it may well bounce here, and there will be a potential double bottom here. On a breakback above 16.5, that double bottom would have a target, because it's a very easy calculation to make. It's just basically you take the resistance level, you take the low, and you basically take the same amount and you add it above. So what are you looking at here? You're looking at a move from 16.5, and that's from 15.35, and you're really looking at 17.65. So as a target area, that is an area to take off profits, especially when you're looking, you've got an established level up here at 17.78. If I've not, I might, this sort of area, depending on how it looks at the time, I'm liable to take off the a final part, because you quite often get to these targets and then reverse, and at that stage it is done. And I think, but alternatively, if I've only taken a third off, that's where I'm taking the second. I'll take it slightly before it reaches that target in case it reverses. It will reverse quite a lot of the time. Actually, I've got a brilliant example of that. I'm just going to show on HG. Hang on. I think it was on HG. Let's have a look. Nope. Sorry, I'm going to have to dig that up. I'll throw you the screen back. I'll have that ready in a couple of minutes. I'll just dig it up because it's happened in the last couple of days. It's just I did charts for 19 instruments this morning.
Just given the time, I think what I'm going to do is I'm going to start taking questions, Jack. And you can dig that up and try to cover it too. Okay, first question. How do you determine time frames on your windows? Time frames, I use a couple of different techniques, but the one I use mostly is Sentient Trader. Let me just show you a quick Sentient Trader screen. I'm going to dig that up here real quick. But what basically Sentient Trader does is it uses an algorithm called Hearst cycles, and that actually helps to paint those high and low windows that you see. So I'm going to show you a Sentient Trader chart here. This is the one I was showing the other night. Can you see my screen, Jack?
Oh, yes, I can.
Yeah, so this is a trading screen of the S&P 500, and as you can see, there are these cycle brackets. And basically, Hearst cycles, it's all about cycle brackets. So, this is the 20-week cycle low here in the S&P 500, and we have a 5-wave structure heading higher. I combine the cycles with Elliott wave and with Fibonacci's, and we're looking at a high, roughly speaking, on like the 10th to 12th. That's basically the width of that window right there. And that's where those windows come from. So, I'm looking for this window to play out, and the low I've been talking about, this low for some time now, in August is here. Okay, so that's Sentient Trader. I use it a lot, and I also use a few other Fibonacci timing tools as well, and they very often correlate, and sometimes they don't. By the way, but anyway, so that's what that's where those numbers come from. Okay.
I found that example, Stan.
Okay, hold on a second, Jack. I'll throw it over to you. I got a question here for you as well after you're done with that.
All right.
On LE.
Okay. This is the wheat chart. Needless to say, it was the last of the 19 I just checked. But this is a lovely example here. You've got a beautiful rising wedge, and these normally break down, but I do often say that these tend to make target pretty reliably when they break the other way. Actually, the same applies to megaphones. But here you've got a lovely example. It's done it the perfect way. If you break up, particularly if you're gapping over the resistance trend line, lovely example of that here, and then it respects that as support, then you've got a very nice situation where you've got a break up, and chances are it's not turning into another pattern. It's not evolving into a larger pattern. Chances are it's just a break up and it's heading to the target. Here, what was the target? Well, as above, so below. It's here you just measure from the point of the break to the base of the pattern, and then you just have an arrow of the same size, and that gives you the target. Very easy. Look how it reaches the target and reverses straight away. That happens a lot. That happens an awful lot. And that is a very good place to take profits. The other thing is, and just while we're here and looking at it, what have you got here? You've got a resistance trend line. Some sort of flag is likely forming here, some kind of bull flag, and you've got a 1, 2, 3, 4 touch resistance trend line. Any short trades while this flag is forming are against that trend line.
Right.
As and when it breaks up, although you need to be cautious about the fact that it may not be established as firm support. You quite often get back tests back below it. But again, many long trades can be against it. You will usually get some kind of a back test on a break of a trend line like this. Particularly relevant to the moment is we have similar flag trend lines on all of ES, NQ, and TF at the moment.
Yep. Okay, next question regarding legging in, would you advise only trading instruments where you can leg in and out?
There was a question on LE, Stan.
I'm going to come back to that because it goes with another question right below it, so I'm trying to combine questions. So in terms of legging in and legging out, I think massaging your trade is a very important part of trading. But by the way, massaging a trade also includes hedging against it, okay, in my mind. So, you might be an options trader and you might be hedging a position with futures or something like that. And if you're doing that, that's legging out, basically, okay? So I think that there are various ways of legging in and legging out, and I think managing your position and locking in profits is part of trading. So Kyle, I would advise trading instruments or finding ways of trading, whether you, and again, I trade options and futures both and sometimes together on the same instrument. So, legging in and legging out, yeah, I think it's an essential part of trading. Jack?
I think you also need to be very careful about adding and subtracting from trades. I mean, for instance, a lot of people are big believers in doubling up on losers. Basically, you make the trade, and it's got a logic to it, because the thing is, of course, if you get a 50% retracement, you can get your money back at that point. But if on the other hand, you're doubling up when it's only halfway through the move, then you'll find that you've actually managed to triple your loss by the time it extends another 100%.
Yep.
So, and the other thing is, if you make a habit of doing it all the time, then what you're doing is you are actually cherry picking all of your worst trades to be your largest ones. And mathematically, obviously, that's not a good idea.
Yep, absolutely. The LE question, I would confirm with a measured move distance for the same target. Your thoughts, question mark?
I think it may well make that target. And actually, if you look at the wedge I was just showing on wheat, what I was talking about was, this one didn't gap through, but it doesn't need to. What have you got here? You've got a perfect back test of the broken resistance trend line. You've got a thrust up out of it. I think it may well make that target. Yep. And my working assumption would be that it will.
Yep, I think you're right. Okay, next question. I've known plenty of traders who strongly believe that trading options isn't necessarily going to protect you from your account blowing up. I would agree with that. I think that if you use options appropriately and you structure your option, you're not trading options naked, okay? You're capturing theta, you're using spreads, you're using ratio spreads, etc., and you're doing it correctly, I think you're managing risk. And if you're managing risk, you actually, with options, have defined risk. Okay, so that's why, with a $30,000 account, I would advise people to look at trading options first. I think futures, the larger your account, the more forgiving you can be in terms of your trading, in my opinion. Okay, can you comment on logical rules one might use to add to a position? What do you think, Jack?
Well, the obvious one that springs to mind is if you are with a trend and you're buying on pullbacks, you will so often get a 50% retracement, and you can basically, if you've exited some at the near the target level, get a 50% retrace, and you can add back again. There are natural levels to look for to add. To a trade where you've still got runners on, and you can basically take off when it's extended on the long side and add when it's retraced somewhat. So I think the 50%, the most popular, and hit far more often than the 38 or the 61.
Yep, absolutely agree.
I really like that one.
And I think that's it, Jack. That's the end of the questions, and I think that's a wrap.
All right. Well, pleasure as always, mate.
Yep, same here, and trade them well, everybody. Take care. Bye-bye.